Welcome back to Report of Silver, your trusted source for sharp silver and gold market analysis. If you want real insights into what is happening behind the headlines, explained in simple and easy English, then you are in the right place. Today, we are discussing a development that could become one of the most important moments in modern silver market history. For years, silver investors have argued that the silver market has structural problems, that physical supply and paper pricing do not always match, and that something inside the system has been preventing true price discovery. Now, for the first time, a major U.S. regulator appears to be acknowledging that concern publicly, and that changes the conversation completely. The big news comes from the Commodity Futures Trading Commission, also known as the CFTC, the agency responsible for regulating futures and commodity markets in the United States. During a congressional hearing on April 16th, the chairman of the CFTC publicly supported a new bill called the H.R. 8007, better known as the Silver Act. At first glance, this sounds technical and maybe even boring, but what it represents is far from ordinary. This is the first time a sitting regulator has openly aligned with the idea that the structure of the silver delivery system itself may be contributing to market instability and pricing problems. So what exactly is the issue? Right now, almost all approved silver depositories used for COMEX delivery are concentrated in one region, near New York City. In fact, all 11 approved silver vaults are located within roughly 150 miles of that area. Think about what that means. The entire official delivery system for one of the world's most important industrial and monetary metals depends heavily on one geographic location. If there is any disruption, whether logistical, financial, or political, the whole system becomes vulnerable. That is what lawmakers are calling a systemic risk, and it is one of the main reasons this bill was introduced. The Silver Act aims to solve that problem by decentralizing the vault network. Under the proposal, exchanges would be required to approve at least 2 silver depositories in each major U.S. time zone: Eastern, Central, Mountain, and Pacific. That would spread storage capacity across the country and reduce dependence on a single region. More importantly, it would place storage closer to where silver is actually produced. States like Nevada, Idaho, and Alaska are major silver-producing regions. Yet much of that silver still has to travel long distances to New York just to qualify for official delivery. That increases transportation costs, creates delays, and can contribute to market inefficiencies. And this is where the bigger issue appears. Supporters of the bill argue that this concentration may be creating artificial price distortions. In simple terms, silver may not always be trading at its true value because the delivery system itself creates bottlenecks. That matters because silver fundamentals have been strong for years. Industrial demand continues to rise, mine supply remains tight, and the market has been in a structural deficit. Yet silver prices often fail to reflect that reality. Many investors have wondered why. This legislation suggests the answer may not just be market psychology or temporary volatility, it may be built into the system itself. That is why this moment is so important. Even if this bill never becomes law, the fact that a top regulator publicly recognized this problem means the debate has changed. The silver market is no longer being criticized only by independent analysts or retail investors. Now the criticism is coming from inside the regulatory system itself. And once that happens, it becomes much harder for the market to ignore. Now let's focus on the most important part of this entire story, why the endorsement matters far more than the bill itself. Many people are looking at the Silver Act and asking whether it will pass or fail. But that may actually be the wrong question. The real story is not the legislation. The real story is that a sitting chairman of the Commodity Futures Trading Commission has officially acknowledged that the current silver market structure may be flawed. That alone changes the landscape. Think about how significant that is. For years, investors, analysts, and silver advocates have argued that something about the silver market does not make sense. Physical silver demand has been strong. Industrial demand continues rising because of solar panels, electric vehicles, and advanced technology. Mine supply has struggled to keep up. Multiple industry reports have confirmed a structural supply deficit, yet silver prices often behave in ways that seem disconnected from those fundamentals. Many investors have asked the same question. If silver is truly in shortage, why does price action not reflect that reality more clearly? Now, for the first time, a major regulator appears to be saying that one reason may be the system itself. That is a huge shift. The CFTC chairman publicly stated that the geographic concentration of approved silver vaults could create vulnerabilities and increase systemic risk. Those are not casual words. When a regulator uses terms like systemic risk, markets pay attention. It means they believe the issue has consequences beyond simple price volatility. It means they believe the problem could threaten market stability. And here is what makes this even more important. The CFTC already has influence over how these markets operate. This is not just symbolic. The agency oversees futures markets and has authority over key parts of the delivery framework. That means the conversation can move toward change even without Congress passing the full bill. In simple terms, the endorsement itself has already created momentum. That is why silver investors are paying close attention. For years, many people believed the market was too dependent on paper silver, contracts, derivatives, and financial instruments, while the actual physical market remained much tighter than prices suggested. As long as investors trusted the system, that imbalance could continue. But when regulators begin questioning the structure publicly, confidence starts to shift. And confidence is everything in a market like silver. If market participants begin asking tougher questions about delivery risk, vault concentration, and physical availability, that can eventually lead to different investor behavior. More investors may prefer physical silver. Institutions may demand stronger transparency. Exchanges may feel pressure to modernize their systems. All of that can create long-term consequences for price discovery. We have already seen signs of stress. In recent years, major silver inventories moved rapidly between London and New York City during periods of market fear. Lease rates surged. Available inventories tightened. Delivery concerns increased. These were not random events. They were warning signals that the system may not have enough flexibility during periods of stress. That is why this endorsement matters more than the Silver Act itself. Bills can fail. Political support can fade. But once a regulator puts something like this on the public record, it becomes part of the official narrative. The issue is no longer speculation. It is now a recognized policy concern. Now we come to what many analysts believe is the core issue in the silver market, the growing disconnect between paper silver and physical silver. This is the part of the story that long-term silver investors have been watching closely for years because it may explain why silver prices often seem disconnected from real-world supply and demand. Let's simplify this. When most people hear the word silver market, they imagine people buying and selling physical silver bars and coins. But that is only part of the market. A much larger portion of silver trading happens on paper through futures contracts, derivatives, and exchange-traded products connected to platforms like COMEX. These paper contracts represent claims on silver, but not every contract results in actual physical delivery. And that is where the concern begins. The paper market is much larger than the physical market. That means many more ounces are traded on paper than actually move physically. Under normal conditions, this system works because most traders never request delivery. They settle financially, roll contracts forward, or simply close positions. But what happens if more investors suddenly demand the real metal? That is the question many silver analysts continue to ask. Because if too many investors request physical delivery at the same time, the system could come under serious pressure. This is not just theory. We have already seen warning signs. In early 2026, tens of millions of ounces were reportedly withdrawn from registered silver inventories in a very short period. That caused concern because registered inventories are the metal specifically available to meet delivery obligations. When large amounts leave that category quickly, it raises an obvious question: how much silver is truly available if demand accelerates? Then there was the stress in London, one of the world's biggest precious metals hubs. During a recent supply squeeze, available silver in the London market reportedly tightened so dramatically that lease rates surged above normal levels. In simple language, that means borrowing silver suddenly became much more expensive, usually a sign that physical supply is becoming harder to access. That matters because lease rate spikes often reveal hidden stress before prices fully react. It is like pressure building inside a closed container. At first, nothing appears wrong from the outside. Then suddenly something changes. That is why many investors call silver a spring-loaded market. The pressure builds quietly until it doesn't. Now combine that with a 6-year structural supply deficit. According to multiple industry reports, global silver demand has exceeded supply for several consecutive years. That means more silver is being consumed than produced. Industrial demand continues rising because of technologies like solar panels, electric vehicles, semiconductors, and advanced electronics. Silver is not just a precious metal, it is also a critical industrial metal. And unlike gold, much of that silver gets used. It disappears into products. It is not always recycled immediately. That reduces available supply over time. So if physical silver is already tight and paper contracts continue expanding, what happens when confidence shifts toward physical ownership? That is the risk. That is the potential catalyst. And that is why many silver investors believe the current market structure cannot continue forever. Eventually, price must respond to reality. If physical demand keeps rising while supply remains constrained, the market will have to adjust. The question is not whether adjustment happens. The question is when. That is why this recent regulatory discussion matters so much. It is not just about vault locations. It is not just about legislation. It is about acknowledging that the silver market may be more fragile than it appears. And once markets begin admitting fragility, investors start preparing differently. Today, because approved silver delivery vaults are concentrated near New York City, physical silver often has to travel long distances just to qualify for delivery. That creates transportation costs, delays, and logistical bottlenecks. It also increases dependence on one geographic region. If more vaults were approved across multiple U.S. time zones, as proposed in the H.R. 8007, the market would become more flexible. Silver mined in western states like Nevada or Alaska could move into approved storage much faster and more efficiently. That reduces friction in the system. And whenever market friction decreases, price discovery improves. That is important because price discovery is how markets find their true value. If there are bottlenecks or structural barriers, prices can become distorted. They may not fully reflect real supply and demand. But when those barriers are reduced, the market becomes more transparent, and that transparency often changes price behavior. This is exactly what many silver investors are hoping for. Right now, silver has spent years trading below, where many analysts believe it should be based on fundamentals. Inflation has risen. Central banks around the world have been buying gold aggressively. Industrial demand for silver keeps growing. Supply remains tight, yet silver still trades far below its historical inflation-adjusted highs. That disconnect has frustrated investors for years. But what if part of that disconnect is structural? What if silver has not been wrongly valued by accident, but because the market system itself has been limiting price responsiveness? That is the argument many analysts are making. And if that argument is correct, then structural reform could unlock something powerful. Not necessarily a sudden overnight explosion, but a gradual move toward more honest pricing. That could mean less artificial volatility. It could mean fewer supply panic events. It could mean lower stress in physical delivery systems. And most importantly, it could mean prices that better reflect actual physical scarcity. That last point matters most, because silver is becoming increasingly important in the modern economy. It is essential for solar energy, military technology, medical equipment, batteries, and electronics. As governments push toward green energy and digital infrastructure, silver demand is likely to remain strong for years. At the same time, discovering and developing new silver mines takes time, often many years. Supply cannot simply be turned on overnight. That creates a natural imbalance. Strong demand, limited supply. That is usually bullish. Now imagine that happening in a market where structural inefficiencies begin to disappear. That is why some analysts believe silver's long-term upside could be much larger than most investors expect. They are not only watching supply and demand anymore, they are watching market reform. Because when a market becomes more transparent, hidden value often begins to surface. And that is exactly why this recent endorsement by the Commodity Futures Trading Commission matters so much. It suggests that even regulators may now understand that the system needs modernization. And once modernization begins, markets rarely stay the same. Now the biggest question becomes, what does all of this mean for silver investors today? The truth is, this is not a story about silver jumping overnight because of one bill or one regulatory statement. Markets rarely move that simply. What this represents is something much deeper, a potential shift in how the silver market is viewed by regulators, institutions, and investors. For years, many silver investors believed the market was undervalued because physical fundamentals were not being properly reflected in price. Now, with the chairman of the Commodity Futures Trading Commission publicly acknowledging structural concerns, that argument has gained a new level of credibility. That does not mean the H.R. 8007 will definitely pass. In fact, it may face political delays or never become law at all. But that is no longer the most important issue. The key point is that the conversation has changed. The silver market structure is now under public scrutiny. Lawmakers are discussing it. Regulators are discussing it. Investors are paying attention. And once a market begins facing that kind of attention, change often follows, whether through legislation, regulation, or pressure from market participants themselves. For silver investors, that creates both opportunity and responsibility. Opportunity because if silver has indeed been structurally mispriced, then any move toward better transparency and stronger physical market representation could support higher long-term prices. Responsibility because silver remains a volatile asset. It can move sharply in both directions. We have already seen how quickly sentiment can change. A few days ago, silver was trading near one level, and within a short time, it moved significantly higher. That kind of volatility is normal in silver, and investors need to understand that patience is part of the game. The bigger long-term picture remains strong. Global silver demand continues to rise, especially from industries like solar energy, electronics, electric vehicles, and advanced manufacturing. At the same time, mine supply remains constrained, and the market has been in a documented supply deficit for multiple years. Those are bullish fundamentals. Add in growing regulatory attention and structural reform discussions, and suddenly silver begins to look even more interesting, not just as a precious metal, but as a strategic asset. That is why many experienced investors are watching this moment carefully. They are not reacting emotionally to one headline. They are asking a larger question. Could this be the beginning of a new phase for silver? A phase where physical fundamentals matter more. A phase where transparency improves. A phase where price discovery becomes more honest. No one can guarantee that outcome, but for the first time in a long time, the possibility feels more real. So my view is simple. Silver investors should stay informed, stay patient, and keep watching the bigger picture. This story is not over. In many ways, it may just be beginning. If regulators continue focusing on market structure, and if physical demand remains strong, the years ahead could look very different from the years behind us. And that is why this story matters so much. It is not just about one bill. It is not just about one hearing. It is about a growing recognition that silver may be entering a new era. If that happens, today's prices may one day look very different in hindsight. This is Report of Silver. If you value honest silver and gold analysis, make sure you subscribe, like this video, and tell me in the comments, do you believe silver's biggest move is still ahead? I'll see you in the next report.